Welcome to This Explainer. Today, we are putting on our financial detective hats to uncover the real story hidden deep inside the numbers of O'Reilly Automotive, trading under the ticker symbol ORLY. We've got a mountain of data to sift through, and we are going to separate the noise from the absolute truth. Let's kick things off with a totally staggering figure right out of the gate, a nearly 4,000% return over the last 20 years. Seriously, that is not a typo. If you had held on to this stock for 2 decades, your capital would have compounded at a level most investors literally only dream of. But as financial detectives, we don't just gawk at a shiny end result. We want to know exactly how that happened, and more importantly, if that same magic is still present in the stock today. To figure that out, we're going to crack the case by looking at 5 key areas: the historic growth story, current valuation and price, intrinsic value and safety, profitability and efficiency metrics, and finally, financial health and risk.
All right, let's jump straight into section 1, the historic growth story.
Our very first clue is that ORLY is definitely not a one-hit wonder. You know, a lot of companies catch a lucky break or ride a single product cycle, but this story is entirely different. We're talking about compound annual growth rates, consistently hitting that 17 to 20% mark across 5, 10, and 20-year horizons. I mean, an 18.67% average over 5 years, over 20 years hitting 20.31%. That level of steady, relentless compounding is the ultimate fingerprint of a top-tier business operation. And here is exactly what's powering it: rock-solid underlying business growth. They are putting up high single-digit compound annual growth in both top-line revenue and bottom-line earnings per share. Notice how that 3-year EPS growth of 9.09% is actually outpacing the revenue growth of 7.09%. That's a huge clue right there. It tells us they aren't just pushing more auto parts out the door. They're actually getting more profitable and efficient with every single dollar they make. So let's roll right into section 2, current valuation and price. Okay, history is fantastic, but as investors, we're paying for the future, right? So you might see a price to earnings, or PE ratio, of almost 29 and think, wow, isn't that a bit expensive for an auto parts retailer? Well, it's really all about perspective. That 28.92 is actually a 12.6% discount compared to its own trailing 12-month average, which sat at 33.10. So yeah, it's objectively a premium price tag, but relative to how the market usually treats this specific stock, it's actually on a slight sale right now. But we definitely can't just stop at earnings. When we check out other multiples, like an enterprise value to EBITDA of 19.42, which is basically comparing the company's core operational cash flow against its total value, or a price to sales ratio over 4, it confirms you are for sure paying a premium. Even the PEG ratio, measuring price against expected growth, is sitting up at 2.24. The market absolutely knows O'Reilly's a compounding machine, and they've priced it exactly that way. Which brings us to section 3, and honestly, a bit of a plot twist in our investigation: intrinsic value and safety. Valuing a company based on multiples is one thing, but what is the actual hard cash generating power of this business worth? We're looking at a recent close price of $88.49. Now, if you run a fair value model based on earnings per share, the stock actually looks a bit undervalued, potentially worth over $98. But if you run a model based on free cash flow, it values the stock at only $61.32. That is a massive discrepancy. Earnings can be finessed with accounting rules, but free cash flow, that is the real tangible cash entering the business. And right now, that cash flow valuation is definitely waving a yellow flag. Quick refresher here before we drop the next crucial number: the margin of safety. This is basically your financial shock absorber. It's the absolute core rule of value investing. You want to buy $1 for 60 cents. If your math is slightly off, or the broader economy tanks, that margin is what protects your capital from taking a massive hit. So the really critical point here is a negative 44.31% margin of safety based on that free cash flow. That literally means the current market price is sprinting way, way ahead of the underlying cash the business generates. You're basically paying $1.44 for one single dollar of intrinsic value. For a strict value investor who absolutely demands a margin of safety, this number alone might make them just close the case folder and walk away. So why on earth is the broader market okay with that? Let's uncover the reason in section 4, profitability and efficiency metrics. These staggering profitability numbers are the perfect alibi. Management is just incredibly efficient. With a gross profit margin of over 51%, they are keeping more than half of every dollar they make right off the top. Even crazier is a net profit margin of 14.21%, which is huge for a physical retail business. But the absolute showstopper? A return on equity of over 244%. They are generating massive, massive profits on a very tight base of shareholder capital.
And this builds into a seriously undeniable competitive advantage. Pumping out a 28% return on invested capital year in and year out means they are compounding money at elite levels. And they do it with relentless consistency. That current ROIC is practically identical to their 3-year and 5-year averages. Basically, every single time management takes a dollar and uses it to open a new store or fix up their supply chain, they're getting a 28% return on that investment. That is world-class capital allocation. And honestly, that's exactly what the market is willing to pay up for. Finally, we have to check the foundation in Section 5, Financial Health and Risk. No detective work is fully done until we check the balance sheet for red flags. At a quick glance, having current and quick ratios below 1.0 looks super risky. A current ratio of 0.76 means their short-term liabilities are actually higher than their short-term liquid assets. At a quick ratio of 0.13, that means they have very little actual cash on hand compared to the bills coming due this year. Now, in a lot of industries, this would be a 5-alarm fire. But in retail, highly efficient companies often stretch out their payments to suppliers while turning over their own inventory super fast. Basically, they let their vendors finance their daily operations. It's really smart, but make no mistake, it leaves almost zero room for error if sales were to suddenly drop. On top of that, we're seeing a deeply negative debt-to-equity ratio of minus 5.81. That signals negative equity on the balance sheet. But hold up, before you panic, this is actually pretty common when a company has massive, sustained share buyback programs that shrink the equity base over time, which we already know ORLY is doing since their EPS growth is outstripping their overall income growth. It shows management is hyper-focused on returning value to shareholders, but it absolutely means the balance sheet is highly leveraged. All right, pulling it all together to wrap up this explainer. What is the final profile of our suspect? Well, we are looking at a company with a legendary 3,941% 20-year return and truly world-class capital efficiency, highlighted by that elite 28% ROIC. But they are carrying a really hefty price tag, tight balance sheet liquidity, and a deeply negative free cash flow margin, of safety sitting at minus 44%. So it all really comes down to this final, provocative question. When you find a business operating this efficiently and compounding capital at such a staggering rate, do you strictly demand a margin of safety, or do you just pay up for undeniable quality? Do you wait around for a massive pullback that might never actually happen, or do you gladly pay a premium for a compounding machine? That is the puzzle you have to solve as an investor. Thanks so much for joining me on this explainer. Keep asking the right questions, and I'll catch you in the next one.